Investors now own more than 50% of Toronto's new condos, and experts say they're driving up housing prices for everyone. So let's dive into this. You can see on this chart the amount of condo units built in blue versus the amount of purpose-built rental units built only going back to 2003, which we're going to talk about shortly, because in the 70s, obviously there was a lot more purpose-built rental. Basically, they go on to say it's an investor's game now, with 40% of homes constructed since 2016 being investor-owned, and investors owning 56.7% of the condos constructed in the last 6 years. Now, this article's been making the rounds and people are furious about this. And honestly, I'm a little bit confused as to why. So let's dig into the numbers a little bit more closely. So the first thing I want to touch on is just the homeownership rate in Toronto. It's higher than it used to be, right? It is declining since 2012, roughly. It's been declining as obviously prices have been rising quite quickly and population has been growing quite quickly as well. It's projected to continue to decline, which I think it will. But regardless, you go back to the 90s, for example, and homeownership was much lower. So the reality is there's always been rentals in Toronto, right? You need places for people to rent. It's just that in the 70s and 80s, we built a lot more purpose-built rental units, and now we build a lot more condo units. So in the good old days, the investors were building purpose-built rentals. And so the investors holding a lot of that housing stock were corporations, REITs, etc. And now the investors are mom and pop buying a rental unit or two from a condo developer that's going to complete in 5 years. And then they're going to turn around and rent those units out. And for whatever reason, people think that is the problem with our housing market. But of course, purpose-built rentals, there's nothing wrong with that. I mean, the outcome here is very similar. It's just the mechanism as to how those rental units are provided to the market is just different, right? You have a lot of mom and pop investors now versus fewer purpose-built rental developers. Now, this article got 250 comments last I checked. So I did the unthinkable. I went into the comment section where you're never supposed to go. And I sorted by most liked. First up here, we've got call the investors what they are, speculators. There was once a time that predatory speculation was illegal. So I guess if it's a REIT or a megacorp building a bunch of apartment buildings, that's not speculation. But the moment it's Uncle Jimmy buying a condo unit or two with his hard-earned money to turn around and rent out on the market, suddenly it's predatory. Uncle Jimmy is a predator. We always speculated, but now we know for sure. Investors, I've called them infestors for years. They're parasites. Probably got all 3 volumes of Capital on his nightstand. Then we've got this one here. Hit them with a massive capital gains tax of, say, 80% on appreciated value. Man, do Canadians love taxation that doesn't impact them in particular. Well, if we're going to increase the capital gains tax on investment sales, we should also address the elephant in the room. And the elephant in the room is the fact that the cost of ownership on these new condos is considerably higher than the rent that these people are getting. So it's about a 62% spread on average for new launches today, meaning that the rental income is projected at $4.21. The ownership cost at today's mortgage rates is $6.81 per square foot per month. So of course they're subsidizing the rental market, a thing that, by the way, purpose-built rental developers just wouldn't do, right? They wouldn't cash flow negative on a monthly basis. So rents would have to be considerably higher, or their cost on the build would have to be lower than a condo build, which we'll get into later in the video. Now look, I realize the public sentiment towards investors and developers comes from a place of genuinely just being disenfranchised and wanting to see the housing market in Toronto, in Canada, improve as a whole. The reality is, with the high cost of housing on both the purchase and the rental market, this demonization, I think, is inevitably going to continue. But I think it's important to remember that deterrence of investing often has unimplied consequences. For example, if we remember back to the Fair Housing Plan, when we rolled out rental control in Ontario, remember what happened to Toronto condo rents immediately following that rollout. They, of course, inflated quite rapidly. Now, another comment here. Does anyone realize how many condos that are actually for rent are sitting empty for months because people can't afford the prices? Thousands of units. Stop falling for the shortage narrative. I really don't understand where people come up with a lot of their stuff. I think a lot of it's just like they're talking with their friends and somebody says something like this. They check House Sigma. They're like, look at all these rental units that have been sitting on the market 30 days. Wow, there's so many empty units out there. The reality is our vacancy rate is lower than Manhattan. It's lower than Los Angeles. It's way lower than Chicago. In fact, it's one of the lowest vacancy rates in the world for major metros here in Toronto. Piggybacking on vacancy rates here, there's actually a very clear correlation between low vacancy and high rental rates. Obviously, exactly what you would expect, I would hope. because a low vacancy rate inherently implies that, there are less rentals than renters. So you can see here, the lower the vacancy rate, the higher the average rent for cities across Canada. Now, interestingly, you know what there isn't a clear correlation for? Investor participation in the housing market versus average housing price. So if you look at this chart here, you can see the average housing price across all property types here versus the percent of investor-owned properties. You can see that London, for example, one of the most investor-owned cities. And as far as house price, pretty much middle of the pack. Toronto and Vancouver with lower than average investor participation, at least. And again, this isn't for brand new condos. This is just the market as a whole has some of the highest prices in the country. Now, of course, vacancy rate just comes down to supply and demand. You've got population growth versus housing completions. And you can see here that in 2022, the GTA saw a net population growth of about 150,000 people. Now, when you look at housing completions for 2022, it was actually one of the lowest years for housing completions as a percentage of population for the last few decades here in the GTA. The dark blue line here is housing completions as a percentage of population, and the light blue line is the amount of resale inventory on the market. Dan Foch made a great chart on the housing shortfall here in Ontario. Basically, he took the population growth, divided it by the persons per household number from the census, came out to the number that we needed about 192,000 new homes. We only built 72,000, so there was a shortfall of about 120,000 homes. This inherently makes a lot of sense to most people, but some people just don't get it. Now, everyone gets it if you relate this to a totally different product, right? So if you say, there's 192 people desperate to see Taylor Swift, but there's only 72 Taylor Swift tickets available, what happens to the price of those tickets? People can answer that instantly. They can come to the logical conclusion. But when you apply the same logic to housing for whatever reason, people trip all over themselves with all kinds of mental gymnastics to say why it doesn't apply. Now, of course, when I'm talking about price, I'm really talking about affordability, because when interest rates increase and buying power is reduced, really, credit availability and the cost of that credit, the monthly service on that debt, is just as much a demand side thing as population growth. And we're seeing this in Toronto now. We're seeing it across the entire country, where housing prices are correcting downwards as a function of interest rate increases, but the affordability is not improving because the price decline isn't enough to offset that cost increase because of interest rates. Funny enough, Yahoo Finance put out an article the other month basically saying investors and investments are key to building more housing in Canada. So sort of the opposite take. And I actually think this take is much closer to reality. It's a little more nuanced here. They basically say one needs land, labor, and capital to build new homes. Obviously, Canada underwent a construction boom in the 70s when it built 2.34 million new homes. You can see that here. 70 through 79, 2.3 million homes versus what we're building today. Obviously a shortfall despite the fact that population is increasing. They go on to say it does not matter whether a dwelling is in a purpose-built rental or a condominium, an individual or a corporate investor. Exactly sort of my point. I think it does matter in the degree of a purpose-built rental provides a little bit more stability for the renter. You don't have to worry about, the owner moving in or the family member moving in, that kind of thing, those types of evictions. So I do think purpose-built rental is a more stable form of housing, and I would like to see more of it built. But a series of haphazard changes to tax laws since the 70s has resulted in a precipitous decline in purpose-built housing construction, which is exactly what I want to talk about here. So over the years, I've sold thousands of pre-construction units, and generally I would say about 70% are purchased by investors. Now, in the 3 to 5 years after the building closes, a lot of those investors will sell their units on the resale market, and those will typically get purchased by homeowners. And so that building demographic will shift over time from predominantly investors to slowly becoming a more mature building with more end users in it. The thing is, though, right now those investors are not purchasing, which is bad for housing affordability in the long run, because you need that chunk, that 70% chunk of buyers and demand in order to get construction started on these buildings. So for example, Urban Nation took a look at the top 10 projects by sales velocity in the third quarter of this year. And you can see the sales percentage here. That's really what we're going to focus on. So you can see number 2 is 55% sold, 30% sold, 47% sold, 22% sold. The problem with this is you can't actually get a construction loan to break ground on your condo building until you're over 70% sold. So out of this list of top 10 launches, there's only one that's actually in a position to break ground right now. So without investors participating in the pre-construction market, as we're seeing currently today, you're just not going to see a whole lot of new housing starts. And that is why 40 projects, so over 13,000 units that would have launched this year, and if they sold, would have been started, so would have helped housing affordability in the long run. Those projects aren't launching this year because developers are worried they're going to get stuck in a situation where they're sitting at 12% sold and they have no idea what to do because they can't break ground and they can't build the building. And you're already starting to see this a little bit in the data. So if you look at the third quarter of this year, it was the worst quarter in over a decade for new housing starts in the condominium sector. And so again, these are units that would have otherwise come online, would have completed and been homes for people, either rentals or end users, in 4, 5, 6 years, depending on how long the condo building took to get built. Those are now pushed way further out in the future because if you don't launch, you don't sell, you can't start. And when you look at the numbers of the rental demand versus the new increase in purpose-built rentals as well as condo rental supply, so the amount of pre-construction that was pre-sold and then listed on the market for rent, you can see that we're already extremely short just over the last decade, right? So we saw 111,000 new rental units come to market. We needed to see 197,000. These numbers are going to get a lot worse if pre-construction sales remain low, which honestly, I expect them to. And this is, of course, why our rent prices in Toronto are increasing so rapidly. So if you look at the last 5 years, rental prices in Toronto on a per square foot basis are up 30%, which is a terrible place to be as a city. Like when you look at the average income required to afford new rentals under the standard affordability ratio of keeping rent below 30% of gross income, you can see that the average renter income hasn't increased nearly as much as the average rent. And this puts a lot of people in really tough situations. And this is why I think you're seeing so much public discourse on housing and people are looking where they can point the finger. And I think they're kind of pointing it in the wrong place. And when people are pointing the finger, look, it's really easy to point it at investors and developers, particularly developers. So Urban Capital puts out a great yearly report on this, and I want to show you this chart from their report. As you can see, developer margins are way down, right? So this is comparing a 2005 build versus a 2020 build. So the profit margin for the developer from 2005 to 2020 is down 45%. Costs are up 139% and revenues are only up 118%. That is despite the fact that in 2005, they were selling at an average of $360 per square foot. And today they are selling at an average of $850 a square foot. So where did those cost increases come from? Well, first up, development charges. So government fees, charges, and taxes are up 3,244% over that 15-year period. That is insane to think about. Then you get to broker commissions, which are up 605%, which for some reason, that doesn't worry me too much. No, in all seriousness, what happened from 2005 to 2020 is developers shifted a lot of their marketing budget away from internal marketing and over to brokers. So essentially back in the day, most people would buy pre-construction directly through the developer. Today, they do so through outside brokers. And so developers spend less marketing. It's a long story. It doesn't really matter. Land prices are up 160%. So, I mean, DCs are huge. Like if you look at the cost to build a 750 square foot condo in Toronto, you can see, your hard cost, your land cost, and your soft cost is $667,000. Your profit margin on a unit is $150,000, and your government charges, taxes, and fees are $237,000. People always tell me I'm an idiot for pointing this out, and growth pays for growth, and a bunch of other cute catchphrases they picked up online. But the reality is it's ridiculous what developers pay for DCs in Toronto. And when I say developers, just realize that I actually mean you, the purchaser, because when you're buying a new condo from a developer, it's important to understand that condos are priced as a cost plus basis, right? There's a minimum profit target that developers have to hit in order to get a construction loan to build the thing. And if they don't hit that target, they can't build. So anytime the government increases costs on developers, it just increases costs on the purchaser. Again, it's just a cost plus. What is it going to cost us to build? Our land, our materials, our fees, our labor, plus profit margin to get the loan, then we go. And I brought receipts on this, okay? So the Greater Toronto Area development charges are on average 3 times more per unit than 6 comparable US cities. So for example, in Boston, development charges make up about 6% of the price of a new condo. In Miami, 13%. In San Francisco, 9%. In Toronto, over 24%. So the number is egregious. Now, some might say at this point, okay, so investors aren't participating in the pre-construction market. Cool. Those units can now get purchased by end users, by homeowners who want to move into those units, and it's a better situation for everyone. The problem is they don't really. Like I said, end users only make up about 30% of the market, largely because pre-construction condos, as you can see here on a per square foot basis, are way more expensive than resale comparables, right? So if you want a comparable unit on the pre-construction market, not only are you going to have to wait 4, 5, 6 years for it to get built, you're also going to pay a 15 to 25% premium in order to buy that unit. So you have a premium plus a wait period, which isn't really conducive for an end user. And the other half of the equation is that most end users buying pre-construction are buying a different type of product than most investors. So oftentimes end users, the 30% of pre-con buyers that are end users, they're downsizers or they're buying for their kids. And usually they're buying luxury boutique product like this, not high-rise, high-density product like this. And investors focus on this because it's more affordable and these pencil better for rentals. Now, you might be thinking to yourself, so why would an investor purchase something that's not going to be ready for 5 years and pay a 15 to 25% premium to do it? Well, the reason as to why they would do that is because it's worked out really well in the past. That's honestly the only reason. So here's a bunch of condo projects that launched back in the day, what they launched for versus what they're selling for on the resale market today. And you can see that, for example, a project that launched in 2016, Scoop Condos, pre-construction buyers would have paid $535 a square foot, which would have been a little over market at the time. Now they're selling on the resale market for $950 a square foot. So again, investors did well, despite the fact that, yes, granted, they would have done slightly better just buying a resale unit at the time. They got to space out their deposits and not deal with tenants and not deal with getting a mortgage for quite some time. So that's why investors like this type of product. From that same development charge report, Altus went on to do a great case study on the difference between building a purpose-built rental versus a condo building in the same location. So the building location was the same, the land cost was the same. Essentially, it was a 400-unit saleable condominium development versus a 400-unit purpose-built rental development. And the outcome at the condo development, selling at $1,500 per square foot, the project yielded just under $40 million or 12.5% in profit margin. Meanwhile, building the same thing but making it a purpose-built rental would be in deficit of $65 million in the first year with a 7-year period to break even. So here's the summary here. I encourage you to go look at it in more detail, but essentially the condo building would have cost $318 million to build. But of course, as soon as it's complete, the owners would have closed out the units, got their mortgages, and they would have walked away with their $40 million profit or 12.5% margin. Whereas on the rental side, it would have cost $315 million to build and would have brought $9.9 million in net operating income yearly, so about a 3% yield. So I mean, just the reality here is unless a developer has different capital sources, I mean, nobody's going to build a $315 million building to catch a 3% rental yield. It just doesn't make any sense from a financial perspective. They went on to do another 400-unit sample site comparison in Mississauga, and the numbers were very similar, actually slightly worse. And of course, the recommendations from Altus is that development charges, parkland dedication requirements, and or planning and building application fees should be reduced or waived to again skew the favor and make it more financially feasible to build purpose-built rentals, which I think is a good place to start. I will leave you with that. Thanks for watching, and I will see you guys next video.